All right, welcome back to Talk Tickers. Today, we're diving deep into Lithia Motors' third quarter earnings from back on October 22nd. Now, this one's interesting because they posted some absolutely record numbers, but the stock, well, it went down. So what in the world is going on? Let's break it down.
Okay, so here's how we're going to tackle this. First, we'll hit the big numbers for the quarter. Then, we're going to peek inside management's playbook to see what they're thinking. After that, we'll get into the real head-scratcher, why the market reacted the way it did. And finally, we'll wrap it up with our take on what you should be watching for.
So first up, the results. And look, on paper, this was a really strong quarter. I mean, Lithia themselves called it a record third quarter.
The headline number everyone looks at? Adjusted earnings per share. And it came in at a whopping $9.50. That's a solid 17% jump from this time last year. Not bad at all.
Now, this isn't just squeaking by expectations. No way. The street was looking for something around $8.70, so they blew past that by about 80 cents per share. That's a pretty big deal.
And hey, the story on the top line? Pretty much the same. Revenue clocked in at $9.7 billion. That's up 5% year over year, and again, easily beating what analysts were predicting.
So let's just put this in black and white. Top line, beat. Bottom line, beat. It doesn't get much clearer than that. On the surface, this quarter was a home run.
Okay, so you're probably wondering, where did all this strength come from? Well, it wasn't just one magic bullet. They saw some really powerful growth in their existing stores, especially in those super profitable areas, used cars and after-sales service. That's really becoming the heart of their business.
All right, so the numbers look great, but what's the story behind the numbers? How did management talk about all this on the call?
The CEO, Brian DeBoer, really laid it out for everyone. He said this quarter was all about one thing: execution at speed. He kept hammering this idea of building a high-quality earnings mix. What does that mean? Well, it means shifting away from just selling new cars and focusing more on those steady, reliable moneymakers like service and parts.
So the game plan was pretty straightforward. They talked a lot about their omnichannel strategy, combining online and in person, and making sure it's actually profitable. They pushed that strategic shift into the high-margin stuff we just talked about, used cars and service, and they kept a really tight lid on costs. But honestly, the real headline here was what they did with their cash.
And they weren't just talking a big game. They put their money where their mouth is. Management basically looked at their own stock price and said, hey, this is a bargain. So what did they do? They bought back over 5% of the entire company in one quarter. That is incredibly aggressive. And they did all that while still funding acquisitions and paying their dividend. That sends a really, really strong signal to the market.
Okay, so this is where it gets interesting and a little weird. You've got this massive earnings beat. You have a super confident management team. You have them buying back their own stock like there's no tomorrow. So what happened?
Yeah, despite all that good news, the stock kind of fizzled out. It was all over the place on heavy volume and actually ended the day down. This is the big disconnect we really need to get our heads around.
I mean, look at this. You've got management on the call using phrases like a rocket launching into space, and at the exact same time, you have investors on Wall Street hitting the sell button. What does that tell you? It suggests the market isn't worried about Lithia specifically, but about the whole auto retail sector. Fears about interest rates, the economy, used car prices, the big macro picture. And this isn't just a one-day thing. If you zoom out and look at the whole past year, Lithia stock has basically gone nowhere. It's flat. Meanwhile, the broader retail sector is up over 12%. So this tells you there's this cloud of investor concern hanging over the whole auto retail space, and Lithia is just getting caught in it. So what are we supposed to make of all this? You've got great company performance on one side and a skeptical market on the other. Where do we go from here? Here's our take for the next earnings call.
All right, so what should you be watching for? It's pretty simple, really. It all comes down to execution. Can they keep buying up dealerships and hit that $2 billion target? Are they going to keep buying back their own stocks so aggressively? And critically, can they keep up the momentum in used cars and service, especially as we head into the holiday season?
Okay, so here's our call. We think the story here, the actual nuts and bolts of the business, is for real. We expect them to keep crushing it, especially in that super profitable value auto used car space. Now look, the stock might stay volatile for a bit as those big macro fears swirl around. But that gap, the gap between how well the company is doing and where the stock is trading, it's just getting too wide to ignore. We think there's huge potential for a re-rating once the market wakes up to the durable earnings power here. That's why we're initiating coverage with an outperform rating.
And as always, remember, this is not financial advice.